Let me start with a number that should make you stop whatever else you're doing. $75,000 turned into $600,000 without picking stocks, trading options, or doing anything that feels like gambling. $75K, $600K. Now here's the twist. Most people who could make that transformation never will. Not because they don't have the money, not because they're bad with finances, but because they're following a strategy Charlie Munger once warned about when he said, "The first rule of compounding is to never interrupt it unnecessarily." Pause for a moment. Doesn't that statement feel uncomfortably true? Because deep down, you probably already suspect something. You've been doing the right things, working hard, paying bills, saving what you can. But somewhere along the way, the system stopped working for you. And today you're going to see exactly how to flip it back in your favor. To turn a very normal amount of savings into the kind of wealth most people assume is out of reach. Here's what you'll walk away with by the end of this video. The exact method that turns $75K into $600K with no speculation. The three Munger principles that almost guarantee long-term wealth if you follow them. A step-by-step plan you can start tomorrow morning. And most importantly, the mindset shift that stops you from sabotaging your future. So let's begin. Charlie Munger wasn't just Warren Buffett's business partner. He was the architect of Berkshire Hathaway's decision-making engine. A billionaire philosopher in a suit. A man who could compress 60 years of wisdom into a single sentence. And when someone like that says something uncomfortable, we should probably lean in a little. Now let's bring this back to you, because you're not here for a history lesson. You're here because the cost of living is rising. Retirement feels further away every year. Social Security looks shakier than ever. And after decades of working, it still feels like real wealth is for other people. You're not alone. 2/3 of Americans between 35 and 65 say they're behind on retirement. And yet, most of them are only one decision away from changing that trajectory. But here's the painful truth. It's not the big financial mistakes that destroy wealth. It's the small misunderstandings that compound over decades. And this is where Munger hits us with another line that should be taped to every refrigerator in America. The big money is not in the buying and selling. It's in the waiting. Pause. Let that sink in. Because the strategy I'm about to show you, the one that turns $75K into $600K, doesn't require brilliance, a fancy income, or insider knowledge. But it does require one thing most people never master: properly applied patience. And that brings us to the biggest misconception people have about building wealth. We think wealth comes from doing more, working harder, picking the right stock, flipping the right house, finding that one magical investment. But Munger said something that flips this idea on its head. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. Here's the transition point. Most people are doing the right actions, but with the wrong framework, which means everything they're doing, saving money, investing, planning, is working at half power. In the next section, we're going to fix that. Wealth doesn't come from intensity. It comes from duration. Charlie Munger said something beautifully simple. The first $100,000 is AB times H, but you got to do it, asterisk, asterisk. Crude? Yes. Accurate? Almost painfully. But here's what people misunderstand about that quote, and this is the key to turning $75K into $600K. Munger was not saying the first $100K is the hardest because it takes the most effort. He meant that once you reach that first milestone, the machine starts working for you instead of the other way around. Most American families reach somewhere between $50K and $100K in savings across retirement accounts, checking savings, and investments by their mid-40 seconds or early 50 seconds. But they don't know how to use that starting point. And that's why today's transformation starts at $75,000. Because at that level, compounding stops being theoretical and starts becoming powerful. The real formula for turning $75K into $600K. Let's strip out the fluff and look at the math. Assume you have, starting point, $75,000. Annual return 7%, the S&P 500's long-term real performance, time 30 years. Additional contributions, $0. Yes, zero. $75,000 at 7% for 30 years equals $568,147. $75,000 becomes $568,147. And if you add just $200 on month, it becomes over $700,000. Let that wash over you. Not day trading, not rental properties, not chasing the hot stock of the month, just time. But here's the deeper insight. Most Americans never get this result, even though the math is simple. Why? Because they interrupt compounding. They change strategies. They panic. They pull money out when the market falls. They think they need something more exciting. This leads us straight to the misconception Munger fought against his whole life. The big misconception: people think they need high returns. Munger once said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." People chase the best investment. But the wealthiest retirees usually chose the consistent investment. So here's the misconception to destroy. Most people think the secret to wealth is finding a 12% return instead of a 7% return. But the real secret is staying invested for 30 years instead of 15. It's not the rate, it's the runway. Let's name them Rebecca and James. Both start with $75K. Both invest in a low-cost S&P 500 index fund. Both earn the same paycheck. Both retire in 30 years. Rebecca leaves her money alone. James pulls money out twice during market downturns and waits 2 years to get back in. That little timing mistake, that emotional reaction, Rebecca ends up with $568K. James ends up with $340K. Same investments, same returns. But because James interrupted compounding, he loses over $200,000. That's the power and fragility of the compounding engine. Mini summary. Here are the 3 truths you need from this first concept. 1, you don't need huge returns, you need time. 2, you don't need special investments, you need consistency. 3, the biggest threat to your wealth isn't the market, it's you. And this sets the stage for core concept #2. Because understanding the engine is one thing, but using it correctly is where most people fall short. In the next section, I'll show you exactly how to apply this to your own life, with real numbers, a real scenario, and the simple adjustments that turn an average retirement into a comfortable one. Now that we've talked about compounding as an engine, let's talk about how to actually use it. Because knowing that $75K can become $600K is inspiring, but unless you have a clear roadmap, most people fall back into old habits. This section is the bridge between understanding wealth and building it. Step 1, put the money in the right vehicle. Charlie Munger had a blunt way of describing how most people invest. If you're not a little confused by what's going on, you don't understand it. So let's make this simple. The most reliable way for ordinary Americans to turn $75K into $600K is a low-cost, broad market index fund, such as Vanguard S&P 500 ETF, Schwab S&P 500 Index Fund, SWPPX, Fidelity 500 Index Fund, FXAI. Why these? Because the fees are microscopic, the diversification is automatic, and you're buying the U.S. economy, not betting on individual companies. Example fund fees 0.03%, 0.02%, etc. Over 30 years, the difference between paying 1% in fees and 0.03% in fees can be 6 figures. Most people don't see it because fees don't hurt today. They hurt every day for 30 years. Step 2, automate everything. Remove human error. Do not trust your discipline. Trust your systems. Set up automatic contributions to your 401k up to employer match, IRA, traditional or Roth, depending on income, taxable brokerage account, if you want faster access to funds. Most brokerage platforms let you automate monthly deposits, auto-invest in your chosen fund, reinvest all dividends. This matters because you invest regardless of market mood. You remove timing errors. You reduce emotional decision-making. You never forget a month. This takes advantage of Munger's principle. The world is full of foolish gamblers, and they will not do as well as the patient investor. Automation turns you into the patient investor. Step 3, add small boosters that have huge effects. Now let's talk numbers. Scenario A, you add nothing. Start $75,000. Time 30 years. 7%. End $568,147. Scenario B, you add $200 month. Start $75,000. Contributions, $2,400 year, time 30 years, and $703,588. That's a $135,000 difference from just $200 a month. Scenario C, you add $500 month, end value $920,000 plus. That pushes you from comfortable to secure. And here's the crazy part. Most Americans spend more than $200 a month on things they don't even remember buying. $600K isn't a lottery. It's a reallocation. Step 4, the case study, a realistic American household. Let me show you how this looks for a couple in their late 40 seconds. Meet Linda and Mark, ages 47 and 50. Between them, they've saved $75,000 total across a 401 CLO IRA and savings. They invest in SWPPX, a low-cost S&P 500 index fund. They can comfortably add $250 a month. Here's their 20-year projection, starting $75,000. Monthly addition, $250, return 7%, time 20 years. Result, $262,000. But that's not the right timeline. Extend that to 30 years because people are living longer. Starting $75,000. Monthly addition, $250, 30 years. Result, $804,000. And here's what's powerful. Even if they never increase their contribution, even if they never pick a single stock, even if the market crashes 5 times, they still end up with over $750,000. That is the power of a plan that does not get interrupted. Step 5, protect yourself from the most common mistakes. Here are the mistakes that derail the average American's retirement and how to avoid them. Mistake shown. Pulling money out during downturns. Solution. Set a rule. You only rebalance once a year. Never sell based on emotion. Mistake #2. Chasing hot investments. Solution. If it sounds exciting, it's probably a gamble. If it sounds boring, it probably works. Mistake #3. Checking your portfolio too often. Solution. Once per quarter is enough. Once per year is ideal. Mistake #4. Holding too much cash. Solution. Keep 3-6 months for emergencies. Invest the rest. Mistake #5. Not increasing contributions over time. Solution. Every January, increase contributions by 1%. You won't feel it, but future you will be thrilled. Why this works, the psychological advantage. Munger said, the desire to get rich fast is pretty dangerous. Most Americans destroy their own wealth because they want results now. But the people who become wealthy, the secure retirees, the calm millionaires, follow a boring plan for a very long time because boring compounds, exciting explodes. This application method is designed specifically for Americans age 35-65 who feel behind, don't trust the stock market, don't have a financial advisor, want a simple, repeatable plan, want to retire with dignity, not dread. In the next section, we level up because concept #3 is where Munger's most powerful, almost secret financial philosophy comes in. This is where the plan goes from good to life-changing. So far, we've talked about the engine of compounding and how to properly set it up so you don't sabotage yourself. But this next piece, this is the part most people never fully understand. It's the mindset behind everything Munger ever taught, the mindset that turns average investors into wealthy ones. And it starts with one of his most important principles. Sit on your A, that's the secret. Asterisk, asterisk. Munger wasn't joking. He meant that wealth is created not by constant action, but by selective action. In other words, you don't need to do more. You need to stop doing the things that destroy your returns. This is the opposite of what most Americans believe. We've been conditioned to think more trading equals better performance. More information equals better decisions. More complexity equals more control. Munger flips that upside down. Advanced insight has shown avoiding stupidity is more important than seeking genius. Munger famously said, "It is remarkable how much long-term advantage people have gotten by trying to be consistently not stupid." People think they lose money because they're not smart enough, but they lose money because they're not disciplined enough. Want to know the real difference between a portfolio that turns $75K into $600K and one that barely grows at all? It's not financial literacy. It's not education level. It's not income. It's the absence or presence of 3 self-destructive behaviors: panic selling, performance chasing, strategy hopping. If you eliminate those 3 things, you outperform the majority of investors automatically. No genius required. Advanced insight #2. You must build a system that overrides emotion. Humans aren't wired for investing. We're wired for survival. When markets fall, your brain screams, "Get out before you lose everything." But the wealthiest people in America, not speculators, not day traders, but doctors, teachers, engineers, small business owners, they build systems that ignore that primal fear. Munger put it simply, you don't have to be brilliant, only a little wiser than the other guys on average for a long time. The key word is long. A long period without emotional mistakes dramatically outperforms short bursts of brilliance. That's why automating contributions, reinvesting dividends, staying in index funds, not watching the market every day are not just financial decisions. They're psychological protection systems. Advanced insight #3. The contrarian rule, wealth follows simplicity. There is a dangerous belief in American finance. If it's simple, it can't be powerful. But Munger often mocked this idea. He said, "Our ideas are so simple that people keep asking us for mysteries when all we have are the most elementary ideas." Translation: the reason simple strategies work is because almost no one has the patience to follow them. The public wants complicated crypto strategies, real estate hacks, technical trading systems, but the wealthy, the truly wealthy, bet on simplicity because simplicity removes emotion, and emotion destroys compounding. Advanced insight #4. Why Munger believed wealth is a moral endeavor. Most people don't know this, but Munger's philosophy around money wasn't just financial, it was ethical. He believed that building wealth slowly through discipline and patience builds a person into someone capable of handling wealth. He once said, "The big money is in the waiting, not the doing." And behind that line is a deeper message. Waiting requires character. Patience requires humility. Sticking to a plan requires integrity. Money doesn't just grow because you invest it. It grows because you resist the temptations that stop it from compounding. To Munger, Wealth building was the result of becoming a certain type of person. Real Munger example: Coca-Cola and the discipline to do almost nothing. In 1988, Berkshire Hathaway bought $1.3 billion worth of Coca-Cola stock. And then they didn't sell. They barely touched it. Decades later, that investment produced tens of billions in value. Not because they traded it, but because they didn't. That is the Munger mindset. Find something reliable, hold it long enough for compounding to create the magic. Don't interrupt the process. Most Americans make the first step, but almost none complete the second or third. Where this leaves us, at this point in the video, your viewers now understand the foundation, the application, index funds, plus consistent contributions. The advanced insight behavior is greater than brilliance. This tees up the perfect transition to the next section. How do you put all of this into a practical, step-by-step plan you can use tomorrow? All right, we've talked about the philosophy. We've talked about the math. We've talked about the psychology. Now let's talk about the part that actually changes your life. What do you do tomorrow morning? Here is a simple, no-nonsense, Munger-approved roadmap you can follow without a financial advisor. Step 1. Choose your investment vehicle, 5 minutes. Pick one of these: VOO, Vanguard S&P, 500 ETF, FXAIX, Fidelity 500 Index Fund, SWPPX, Schwab 500 Index Fund. Doesn't matter which. They're nearly identical. If you already have a 401 or IRA, choose the S&P 500 equivalent inside your plan. Choose one fund, stick to it, don't touch it. Remember Munger's line? The big money is not in the buying and selling, but in the waiting. This is where the waiting happens. Step 2, put the first dollar in. Open or log into your 401 Roth IRA, traditional IRA, taxable brokerage account. Move the money, that $75K or whatever your starting amount is, into the index fund. Is the market up today? Is it down today? Doesn't matter. You are not timing the market. You're building a system. Step 3, set up automatic contributions. 3 minutes. This step makes or breaks your outcome. Set a monthly automatic deposit of $200, $250, $500, whatever feels realistic. Why? Because even a small contribution dramatically accelerates the compounding curve. $75K alone, $568K, $75K plus $200, month $703K, $75K plus $500, month $920K plus, 3 bars showing each future value side by side. If you have a 401, raise your contribution rate by 1% every January. You won't notice it, but your future self will. Step 4, protect the engine. 1 minute per rule. These rules are non-negotiable. Rule has shown never sell during a crash. If the market drops 20%, 30%, even 40%, your feelings will say get out. But your future wealth depends on staying in. Rule #2, ignore forecasts. Experts can't time the market. You definitely don't need to. Rule #3, rebalance once a year. Not weekly, not monthly, yearly. Rule #4, automate dividends. Always reinvest. These keep you from interrupting compounding, which is the Hay-shown reason most Americans never reach financial security. STE5, build a simple 30-year plan. 1 minute. Here's the simplest plan in the world. Invest in one broad index fund. Add a little every month. Don't touch it. Let time do the heavy lifting. Review once a year. Munger would say, take a simple idea and take it seriously. That's exactly what you're doing here. Step 6, remove the what-if objections. Let's knock out the biggest concerns. What if the market crashes? It will. You'll be fine. Historically, it always recovers. What if I'm starting late? Starting late is still starting, and compounding works at any age. What if I don't have $75K? Then start with whatever you have. The strategy doesn't change, the timeline does. What if I'm scared to invest? Being scared is a sign you're doing something wise. It means you respect the process. What if I mess up? You will. But if your system is automated, your mistakes won't matter. Here's the real transformation. You're not just turning $75K into $600K. You're turning confusion into clarity. You're turning fear into confidence. You're turning I hope I retire into I will retire. And if Charlie Munger were alive to say one final thing to you right now, it might be this. The wise ones bet heavily when the world offers them that opportunity. And the rest of the time, they do nothing. This is your opportunity. The rest is waiting. Let's zoom out for a second. Because this video was never just about money. It was never just about turning $75K into $600K. It wasn't even about Charlie Munger, although his wisdom is the backbone of everything we've talked about. This video was about control. Control over your time, control over your future, control over the decades you haven't lived yet but will. Most Americans never get that control because they're stuck reacting to life, reacting to bills, to fear, to the news, to the market, to uncertainty. But you now have a plan that doesn't require reacting. It only requires following a few simple, repeatable behaviors over time. You understand compounding. You understand the vehicle. You understand the psychology that protects your wealth. You understand the step-by-step actions that build your financial future. You've learned the core of Munger's philosophy, the one he lived for nearly a century. The game of life is the game of everlasting learning. And today, you learned something that can change the trajectory of the next 30 years. So if there's one message I want you to take away, it's this. Wealth isn't built by the lucky. Wealth isn't built by the genius. Wealth is built by the patient. And patience is something you already have. You just needed a roadmap. If this video helped you see wealth building in a new light, hit that subscribe button, not for me, but so you don't miss the next step in this journey. Because in the next video, we're breaking down how to build a $1 million retirement portfolio even if you started late. Trust me, you do not want to miss that one. And before you go, I want to hear from you in the comments. What was the biggest mindset shift you had during this video? Was it the compounding math, the system, the Munger philosophy? Your answer might be the one that helps someone else finally take action. Thank you for spending this time with me. Remember what Munger said. Take a simple idea and take it seriously. If you do that, wealth becomes not just possible, but almost inevitable. See you in the next video.